Hello traders, welcome to your daily economic calendar update for Friday the 6th of March 2015. Yesterday we've seen a lot of information come out regarding the markets, and it's going to be information that will haunt the markets and for a little while to come. Where we kicked off the session with the RBNZ actually coming out with a statement saying that they're looking at ways of tightening property lending rules. Now they're doing this to try and contain the property bubble which is going on over in New Zealand, and this new policy that they're looking to do is to try to give the same lending rules currently in the market for people that are looking to buy homes for residency, but charging an increased rate for those that are looking for investment purposes. Now they're looking to do that to try and tamper down or hamper the property market from international investors which are coming in, buying up property and pushing up house prices far greater than what the economy can foresee as being sustainable, and therefore potentially leading to a property bubble. Now they're trying to do this without using the typical methods of raising interest rates, because the rest of the economy they've got a two-speed economy like Australia and Canada, where commodity prices are down, and Australia and Canada, their economies are affected by this and not performing quite as well. However, they've got a housing bubble where housing prices just keep growing and growing from international investors coming in and purchasing. In Australia and New Zealand, it's the Asians and other countries coming in, investing their money into property and pushing property prices up. In Australia last week, we had a house go for $1 million over the reserve price. That just shows you how crazy things are getting, and the fact that the RBA and the RBNZ are both identifying this in their policies is quite interesting, and it is alarming and a reason for concern on the property prices. So the RBNZ are looking to put in measures where the interest rate for people buying an investment property could be greater than the current Reserve Bank rate. Now that weighed very heavily on the New Zealand dollar. That fell quite sharply, and it's definitely indicated that a new trend. The recent trend has been upwards towards resistance level. Go to my previous technical videos and you can see that. And I'll present another trading opportunity on shorting the New Zealand in the technical video later today. We also had, following that, the whole world was focused on the ECB and what's coming up in the future. Now, basically on the 9th of March, the ECB will start their quantitative easing program. But the market Draghi came out with very positive comments to start off with, and he basically indicated that the quantitative easing that they've done so far has helped, and they're starting to see signs of that improving. So the euro rallied quite heavily on all of the good comments that he had. He indicated that fourth quarter growth was stronger than expected. There's improvements in the economy, and he sees further improvements in the economy going forward. And he's quite optimistic about the impact of quantitative easing and the current quantitative easing program, which he announced last night, will have on the Eurozone. So the euro rallied quite heavily. But then he started mentioning comments like the program will run until September 2016. However, it will be extended past this date should a sustainable 2% inflation rate not have been achieved by then. He also mentioned that he has no concerns over the government finding bonds to buy. And he even indicated that they're willing to buy bonds with a negative rate, and a negative rate up until the negative deposit rate right now, the policy rate. So they're willing to buy debt with even a negative return, and then that just set the euro lower. So the details that came out were quite positive at the start, and then once he elaborated a bit further in Q&A, it really hammered the euro. It's now consolidated, and everybody's licking their wounds, going away, and they're trying to figure out, well, the quantitative easing is, on one hand, flooding the market with $60 billion a month worth of government bonds, and the effects that this has on the Eurozone economy and the rest of the world for that matter. But then on the other hand, this stimulus is also helping the conditions in Europe, and it looks like that it is doing what they're hoping it would do, and we may be able to see the light at the end of the tunnel. So we'll have to keep an eye on it moving forward. It's hard to pick out what the market's going to do at this point. However, there's very clear signs of resistance and support that a breakout of these levels would definitely indicate what the market sentiment is currently running off. So that's where we're at. But looking forward, we have the non-farm payrolls tonight, the biggest announcement for the US dollar for the year. And it's quite interesting of what we are going to have. The US economy's data coming out of late hasn't been overly impressive. It hasn't been bad, but the expectations have risen and people are coming to expect much more from the US economy. And we are starting to fall short of those higher expectations. So it's not that they're doing bad, it's just the expectations have risen. But there's an argument that we could see a weaker non-farm payroll tonight. We've had jobless claims at a 4-week low. Jobless claims have risen, and our continuing claims have also risen. We've had a lower ADP employment change. There's been a 20% rise in job cuts. The University of Michigan's Consumer Sentiment Index dropped. We've seen a decline in Consumer Confidence Index. And the employment component of the ISM manufacturing that was out this week also dropped. So there's not a lot of data to suggest that we're going to have huge numbers coming out of the non-farm payroll. So we could see the payroll still rise by 200,000, and we could still see the unemployment rate hold steady, but the average earnings growth could have slowed, and the numbers could actually be in the low 200s. And that would just make for quite a subdued report and possibly not have a major impact on the US dollar. So we'll have to keep an eye out on that, and I don't think we're going to see a massive surprise to the upside. But once again, I could be proven wrong, and I'm just like anybody, and these things are going to be hard to predict. So don't try and preempt the news and get in there earlier. We'll just try and do what we can. We also have, if we go over to our calendar here, we have a look at the consumer inflation expectations for the UK. That will be watched by the market, following by the gross domestic product. So the Eurozone here could actually get a boost if the numbers come out positive. We'll see what happens here, and likewise with the inflation expectations for the UK. Then we just move to the non-farm payrolls and the unemployment rate. So they're the major data coming out tonight. That's all we've got to focus on. It's still a fair bit, and the market is still chewing over Draghi's comments last night, and you'll see some more commentary out on that. Make sure you tune into the technical video, because there is some opportunities there, like I said, shorting the New Zealand and a few other charts that I want to show you. And have a great weekend. I'll be back again next week, so until then, trade well.